Hello and welcome to Mr. Allred's 5 Minutes On. Today I'm going to be talking about PLCs in relation to types of ownership. This is a GCSE standard a sort of understanding of that concept, linking it to growth from theme 2 of the Edexcel GCSE. It is in the other GCSE specifications, but I'm not entirely certain where it fits. If you're looking at A-level, there will be another video I'm doing later on PLCs, which will go in more in depth and look at things like divorce of ownership and control and profit satisficing. So let's get going. Before we start with PLCs, let's have a review of the 3 types of ownership that you should already understand from theme 1. These are sole traders, partnerships, and private limited companies or LTDs. So a sole trader is one person who creates a business and has sole responsibility for all the decisions within that business. A partnership is where a group of people set up a business and have shared responsibility for this. Both those types of ownership have what we call unlimited liability. And what that means is that in law, those people who set up that business, that sole trader, is exactly the same as the business in the eyes of the law. So if I was to set up a hairdresser's, for example, as Mr. Allred's hairdressing shop, me, the person, Mr. Allred, and the hairdressing shop would be seen as the same legal identity. And therefore the debts of the business are my debts, and should the business fail, I'm liable for that money. I have to pay that money. We then have private limited companies, and private limited companies are where I have some shareholders, some people who own a portion of my business, and I have what we call limited liability. I'm protected by the laws of limited liability, which means I can only lose the amount of money that I invest into the organization. These organizations tend to be small to medium, and there's lots and lots of benefits of being an LTD, such as, you can choose who the shareholders are, which is a key difference when we go to look on to PLCs. So there's a further type of ownership, which is a PLC, and lots of the world's largest organizations are this form of ownership. Okay, so what is a PLC? So PLC is a public limited company. Now lots of people do get confused. There's a misconception here that they think it's in the public sector, it's owned by the government. It's not. It's a private sector organization, and it's called a public limited company because the public, anybody, can buy shares, can buy a portion of that business through the stock market. Essentially, when you buy a share, you're buying a share of the assets, or what the worth of that business went through, like I say, the stock market in London. So what's good about being a PLC? Well, the key thing is you get massive capital injection. Businesses need money. We know this. You have to spend money to make money. If you want to grow, you want to get bigger, you want to expand your product range, you need money to do so. And often it's really hard to raise that money in other ways. Flotation on the stock market gives you this massive capital injection, this huge sum of money that can be used to then do whatever you want with it. This isn't profit. This isn't money that you can make and keep. This is money designed in the form of capital, designed to forward your business, to make your business bigger and better. Okay. There's a bit of misconception with these shares and how they're sold, and often people think, well, sell shares and when it's sold the business continues to get money. That's not true. It's only when they initially sell the shares that they get that money in. Once I, as a member of the public, have bought some shares, well, that's mine. If I sell it, I'm entitled to the money from that. That's my money. This is why this form of ownership has to have limited liability, because nobody would be attracted to this business if they could be liable for the debts of these massive organizations who will have big loans that they have to pay out, big overdrafts that need to be paid back. Nobody would invest in this business if it wasn't limited liability, and me, the person, was a bit away from the ownership structure and the management structure of the organization. There is a downside to this though. Anybody can buy shares in these organizations, which means that you are at risk, you are vulnerable to hostile takeover. There's been lots and lots of hostile takers throughout history of business, but you open yourself up that anybody can buy shares, and you can't stop a rival business buying your shares. For example, Cadbury's is now owned by Kraft, an American company. Another downside is it is argued that it can weaken a country's economy. Like I just said, Cadbury's is now owned by an American company. That's a British brand, a really renowned British brand. Weetabix is owned by Bright Food, which is a Chinese brand. You do get this loss of sort of British businesses because they are bought by abroad. So that's been Mr. Allred's 5 minutes on PLCs. It can be quite complex of a topic, but the key is the massive benefit of the injection of money into the business. Please like the video and please follow.